There was some small technical glitch which made me end that particular session. I've started it afresh. So let's continue from where we left in the previous one. We left in the middle of the fourth one. You're doing that Mr. Kurka's financial statements, final accounts to be precise. So I ran you through the trial balance and I told which item will go to trading account, which will go to P&L, and how does that impact the balance sheet. We were left out with this adjustments part, errors that was supposed to be rectified. Let's continue. So the first one, purchases included sales returns of rupees 5,000. So purchase wrongly include sales returns. We would have to subtract it from purchases, and further it would have to be deducted from our sales as well because it is sales return at the end of the day. So 5,000 would have to deduct it from purchases, and I would have to deduct it from sales also. So this and this are connected. It was sales return, but it was wrongly included in purchases. So I'll deduct it from my purchases. I'll deduct it from my sales return. So done with that adjustment. Yeah, if I have to tell you the journal entry, that journal entry will be sales return account debit to purchase account. Done. Next, and sales included purchase return of 4,000. Again, same thing. We'll deduct this 4,000 from sales as well as from purchases. 4,000. 4,000 deducted from sales, 4,000 deducted from purchases because it is purchase return. For this, the journal entry would be sales return. Okay, sales account debit to purchase return account again. Done. Next one, goods withdrawn by the proprietor for own consumption 2,000 were included in purchases. So this 2,000 has to be deducted from purchases, and it also has to be deducted from drawings. I repeat, sorry, added to drawings and deducted from capital. So this proprietor's own consumption ke liye whatever goods are there, this has to be deducted from our purchases and then capital. Okay, let us see drawings 2,000 here. Then I'll show it to you in the balance sheet. Balance sheet mein capital they would have deducted 2,000 drawings. Get that? Because the journal entry for drawings of goods is drawings account debit to purchase account. Done. Wages paid for installation of plant and machinery amounted to 2,000 were including wages account. So I would have to deduct this 2,000 from my manufacturing wages in trading account, and I would have to add this 2,000 to my plant and machinery in the balance sheet. I repeat, I would have to subtract this 2,000 from my manufacturing wages in trading account, and I would have to add this to my balance sheet plant and machinery. Let us do this. Okay, here, okay, this is P&L, trading account. 2,000 I'm deducting this year. That would give me 53,000 as manufacturing wages. It is to be capitalized because this expenditure is incurred in the process of setting up or making that plant and machinery ready to use. So in the plant and machinery, I would have to add this 2,000. See, I would add 2,000, making it from 70 to 72,000. Done. Then the depreciation adjustment is given at a later stage. We'll see it later. So I'm going in an order. Free samples distributed publicly costing rupees 2,500 but was not recorded. Free samples is an expense. The journal entry is advertisement expenses account debit to purchase account. I would have to subtract from my purchases, and I would have to write on the debit of my P&L account. I repeat, advertisement expense, the journal entry is advertisement expense account debit to purchase account. Now I would have to subtract this from my purchases and also write in P&L account debit side. Let us do this. From my purchases, it is deducted advertisement expense. So purchase is completely done. Now we'll have to write this in this 2,500 on the P&L account debit side. What is the journal entry? 2,500. Journal entry is advertisement account debit to purchase account. Perfect. Let us see the next one. An advance of rupees 5,000 to a supplier was wrongly included in the list of debtors. So you have given advance to a supplier, a creditor, but is wrongly written as debtor. At the end of the day, debtor is a debtor, creditor is a creditor. So instead of writing advance to supplier, you wrongly included in debtors. So I will deduct it from my debtors and write it as a separate item in the balance sheet asset side. At the end of the day, it is an asset, but you wrongly included in debtors. Now you would have to write it separately. What will you do? You will subtract from the debtors and then write it as a separate item in the balance sheet asset side only. So let me do that. Balance sheet asset side, from the debtors, I'll deduct 5,000 and write it below debtors as advance to suppliers in asset side only. No difference. It's an asset, correct, but it is wrongly included in debtors. Okay, see, I will deduct less advance to suppliers and I'll write here advance to suppliers 5,000 separately from here to here. Yeah, I'll deduct one debit, I'll write one more debit. So technically there is no difference, no impact on the balance sheet as such. Okay, next one. A dishonored bills receivable of rupees 2,000 returned by the bank with whom it had been discounted had been credited to bank account and debited to bills receivable account. When a bill is received back, the journal entry will be bills receivable account debit to bank account. What have they done? Discounted had been credited to bank account, debited to bills. Correct, isn't it? Okay, later it had to be again, you would have to subtract it from your bills receivable and then write it to the debtor. Let us see. They have not done that. I'll tell you. You receive a bill from a debtor and then discount it to the bank. If the bank dishonors it, then the banker gives that bill back to you. You would have to give it back to debtor. What we've done is the banker is given it back to us by deducting my bank balance and my bills receivable has increased. That bill has to be given back to debtor now. So I would have to deduct my bills receivable, add back to my debtors. How much? 2000. Let us do this. I would have to deduct my bills receivable, add it to debtors. See, I've added 2000 to debtors. I'll deduct 2000 dishonored. So this is pretty simple. A customer of mine gave me a bill. I gave it to the bank. Banker returned it to me. I would have to return to the bank. I would have to return to the debtor. But what has happened? I've received it back from the bank, but I've not given it back to my customer. I would have to do that. If I do that, my bills will reduce because I'm returning it to him and he owes me money, debtors will increase. So technically the journal entry in this case will be debtors account debit to bills receivable. Debtors account debit to bills receivable. Debtors account debit add, bills receivable account credit less. Why are we doing this? This is opposite of receipt. When we receive the bill, what is the entry that we write? Bills receivable to debtor. When we return the bill, we write debtor to bills receivable. So that is with respect to this one. Next, what do we have? Next, we have adjustments. What are the adjustments? Charge depreciation 15% on plant and machinery, 10% on furniture. We would have to deduct this 15% and 10% from the balance in the balance sheet inner column, and the depreciation amount has to be posted to P&L account debit side. Why? The journal entry for depreciation is depreciation account debit to the asset, whatever is that respective asset. So depreciation is expense in P&L and it is reduction in the value of the asset. How much? 15 and 10%. Have a look. 15%, 10,800 and balance is 61,200. 5,000, 10%, this one. This 10,800 and 5,000 has to be written to P&L account debit side. Have a look. 10,800 and 5,000. 10,800 and 5,000. Do you see it? Yes, 10,800 and 5,000. Total depreciation comes to 15,800. Perfect. Now we are left with the last adjustment, that is with regard to provisions. Let us do that. Provision for doubtful debts at 5% and provision for discount at 2% is to be maintained. Okay, let us do that. Now how much is the debtors? Debtors is 1,40,000. Concentrate. This is an interesting one. Debtors is 1,40,000. Add back dishonored 2,000 it came, and then less supplier ka whatever we do, we get 5,000. So right now how much do we have? 1,40,000 minus 2,000. Sorry, 1,40,000 plus 2,000 minus 5,000. We were at 1,37,000. How much is the percentage they have told? They've told us to maintain it at 5% into 5%. That comes to 6,850. What did I do? 1,40,000 plus 2 minus 5. I wrote at 1,37,000. Now I did 1,37,000 multiplied by how much percentage? 3%, isn't it? No, 5%. It is to be maintained at 5%. Have a look. They've given here. Provision at 5%. Provision at 5% comes to 6,850. So 6,850 rupees should be the provision. Am I right? Okay. Now 6,850 should be the provision. But if you guys can observe, there is some existing provision. How much is the provision here? 2,000. Okay. This is old. How much is the new provision? 6,850. Now, how much is the to be created provision? 6,850 should be the provision, but actually the provision is 2,000. If I subtract 2,000, 4,850 expense. This is the provision to be created. The provision that you have is 2,000. The provision that you should have is 6,050. So what is the additional provision being created during the year? 4,850. This will be expense in P&L account. I will show it to you. 4,850. Where is it? Okay, they've adjusted both everything together. 6,850 bad debts they've added together, but 3,000 I've already ticked, isn't it? 6,850 minus 2,000 is 4,850. That's what I told. What they've done is they've written that bad debts also together. Can I write it separate? Yes, you can. Now let us see with respect to provision for discount. Okay, boss, 4,850 is done. Whatever that 6,850 is done. Now, if I take 1,40,000 plus 2,000 minus 5,000 minus 6,850, I'll be left with 1,30,150. On this 1,30,150, I'm supposed to maintain a reserve for or a provision for discount at 2%. At how much percentage? 2%. How much does that come to? That comes to 2,603, whatever they've written here. But I have a look in the question. Trial balance, how much is there? It is 1,000. New thing, how much should it be? 2,603. So how much is the expense? 1,603 is the expense. There is a provision. The money that is kept aside, 1,000. Now you are expecting it to be 2,600. The difference is the new expense. How much? 1,603. So 1,603 should have been written in P&L account debit. Perfect. How? 2,603 is the new provision that should be maintained. 1,000 is the old provision. The difference is the provision to be created. 1,603. Yes, guys. I hope this has made sense to you. Then let's go to the last thing that they've given in the question. Closing stock is of 80,000 rupees. That's it. This should go to two places. Trading account credit side, balance sheet asset side. Now my trading account credit side 80,000, and now my balance sheet asset side, where is it? 80,000. Perfect. Now everything is done. I'll show you. Everything is ticked in our trading. Let's start with trading. Trading account. Have a look. Is there anything left unticked? No, everything's ticked. Everything's ticked. So we'll find this as balancing figure. Gross profit. This gross profit of 1,40,500 is posted to P&L. Have a look. 1,40,500. That's the only time left unticked. Only item left unticked. This 4,850, 7,850 comes because of that. And if we add total and then balance it, this will be our net profit. This should be added to capital. How much? 46,497. 46,497 is added to capital. That's it. So I'm done with the entire problem and my balance sheet tallies. You guys get that? So this is the solution. Have a look at it once again peacefully at your own speed and you should be able to crack it. Yes, come on. Let us go to the next one. Next one we have with us question number 5, which basically talks about bills of exchange. Then we have 5B partnership. Then we have question number 6, which is theory questions. Okay. We're done with 80 marks so far. I can do the discussion which is like really quick, finishing the entire paper in an hour and a half. I can do a detailed discussion wherein I can solve every bit of it by telling the concept around it for 6 hours. Or I can do examination approach. Like we did one examination approach wherein we solved the examination paper of November 2019 in less than 3 hours. Yeah, we took 3 hours, less than 3 hours. I explained it also and I wrote down every bit of the answer. So I can do it either of the ways. So it's just that what suits rightly for that occasion is what we stick to. Yeah, don't judge me, please. Come on, let's go ahead. So Jaya and Didi. This is the transaction between Jaya and Didi. So we're supposed to prepare journal entries in the books of Didi. Okay, Didi. Let us start. Jaya accepted a bill. So you're supposed to see from whose perspective? Suppose see from Didi's perspective. Suppose see from Didi's perspective. Don't forget that. Jaya accepted a bill. Okay, for rupees 10,000 drawn on her by Didi. So to Jaya it is bills payable. To Didi it is bills receivable. Didi is supposed to receive money. So from Jaya. So Jaya has accepted, signed the bill, and Didi as basically receiving the money. So for Didi, what is it? It is bills receivable. So the first journal entry is bills receivable is an asset coming in. Bills receivable account debit to Jaya account. How much? 10,000. Have a look. Bills receivable account debit to Jaya account. Bills receivable account debit to Jaya account. Bills receivable account debit, Jaya account credit. 10,000, 10,000. Let's go to next one. This was for the amount which Jaya owed to Didi. Okay, no problem. On the same date, Didi got the bill discounted at her bank. This is not his, sorry. At her bank for rupees 9,800. Okay, when she gets it discounted, she'll receive money. Yes or no? So bank account debit. What is going out? Bills receivable account credit. But how much money will you receive? Bank account debit will be to the extent of 9,800 because you will receive only 9,800. Bank account debit 9,800, whereas bills receivable account credit will be 10,000. The difference of 200 will be discount expenses, discounting charges. I'll repeat. Didi has taken this bill to the bank and then she has given the bill. So bills receivable worth 10,000 is going out. Credit 10,000. Then she receives 9,800 from bank or into her bank account. So 9,800 debit her bank account. 20 rupees is her expense. So that is also supposed to be debited. So the journal entry in the books of Didi here is bank account debit 9,800, discount account debit 20, to which account? To bills receivable account 10,000. Have a look. Look. Bank account debit 9,800, discount account debit 200, bills receivable account 10,000. Perfect. Dates you can just write it. And narration, the same thing, you'll write it with the word being in it because you're a Salman Khan fan. That would serve the purpose. On the due date, Jaya approached Didi for renewal of the bill. Okay. Jaya told, okay, Didi, bill renew karona Didi, because banker will come and ask Didi and Didi has to pay money, no? Then Jaya told, okay. Yeah, okay, Jaya. So Didi told, okay, Jaya, let's renew the bill. Meaning we're like the bill is supposed to end on this date. Banker will come to Jaya and Jaya is supposed to pay money. So what is Didi doing is, okay, fine, I'll take that bill back. When you're taking that bill back, it's almost like a dishonor. When a discounted bill is supposed to be renewed, it's almost like a dishonor. The bill comes back from banker to Jaya, and then from Jaya to Didi. Sorry, banker to Didi, Didi to Jaya. That's how it goes. So banker gives the bill back. So what is the journal entry? Bills receivable to bank. Have a look. The new bill, Jaya to bank account. Oh, fine. I am basically trying to tell two entries. One is bills receivable account, debit to bank account. Then Jaya account, debit to bills receivable account. Like I'm telling, you will receive the bill back from the bank and then give it to Jaya. But what Didi is doing is straight away she's writing Jaya to bank. Instead of writing Jaya account, debit to bank account, can I write bills receivable account, debit to bank account? Because banker is giving me the bill and I am supposed to pay to banker. Entry number one. Second, I am giving that bill to what to say Jaya. So Jaya account debit to bills receivable. So their bills receivable credit debit will get cancelled. So straight away they are taking the bill from the bank to Jaya. Jaya is receiving the bill from the bank. So Jaya is supposed to pay us money. Jaya account debit, and the banker is credit because I paid the money to the bank. Simple thing. On the maturity date, Jaya is supposed to pay money to bank. Jaya doesn't have money. She's asking for renewal. So what will I do? Jaya is the employee in my house. So instead of maid in my house. So instead of Jaya paying, I'll pay on her behalf to bank. So she has to pay me. First, I'm paying to bank. My bank balance decreasing. Credit. She has to pay me. So Jaya account debit. So Jaya account debit to bank account. Done. Okay. So for this extension, we're actually charging her some interest along with interest on the remaining amount at 12% per annum for 3 months. So what do we do? 10,000 into 12% into 3 divided by 12. That comes to 300 rupees. So no, not 300. 8,000. Oh, she's paying partly cash. Oh, Didi agreed on a condition that 2,000 rupees to be paid immediately. 2,000 rupees she'll pay immediately. So I'll write cash to Jaya 2,000. 10,000 is supposed to be paid by her to me. 2,000 she pays. I'll subtract 2,000. 8,000 what she's supposed to pay. On that I'm charging interest at 12% for 3 months. I'll do 8,000 into 12% into 3 by 12. How much will I get? I will get 240 rupees. 8,000 into 3 by 12 into 12%. 240. It is interest income to me. So interest account credit. Jaya is supposed to pay money to me. So Jaya account debit. Jaya account debit to interest account. Jaya is supposed to pay me receivable debit. Interest is my income credit. And she pays me 2,000 immediately. You guys get that? Next, cash 2,000 she pays and 240. 2,000 immediate cash payment plus interest 240 also she pays. With regard to balance 8,000, she gives me a bill, another bill to 10,240. Jaya is supposed to pay me 10,000 for the old bill, 240 as interest. Totally, she is supposed to pay me 10,240. Out of that, 2,000 plus 240 interest, she gives me cash. Cash account debit 2,240. She gives me a new bill, that is a renewed bill for 8,000, 8,000 debit to 10,240, that is to Jaya account. Perfect. Let us go to the next one. Then what happened? The arrangements were carried through. On 31st of December 2017, Jaya became insolvent. How do you know? She jumped into the water and then she didn't dissolve. Yeah, bad joke. Laugh at it because you need to be little relaxed in here with your exams popping up. Yeah, you don't be like oh all the time and then oh should I laugh? No, no, be little humorous also. It helps you relax your brain. So laughing is good. Please laugh, not at my face, but at the jokes whichever you people hear. Okay, guys. So Jaya became insolvent and paid 40%. So Jaya is supposed to pay us 8,000. In that 40% she'll pay. That is 3,200 will receive. What about the balance 4,800? Bad debt. Have a look. 3,200 cash account debit. This is received. Jaya account debit to bills receivable account. This is reversal of the earlier entry. Done. Then 3,200 cash we receive. 4,800 bad debts to Jaya account. Why did I write Jaya to bills receivable? Bill is given back to Jaya and Jaya is supposed to pay us money. Jaya is our debtor now and it's increasing. Jaya account debit. Bills receivable is an asset going out credit and cash is being received 3,200 debit. Bad debts is an expense 4,800 debit and credit to Jaya because she is no more supposed to pay us money 8,000. That's it. We're done with this question. Shall I take you to the next one? Next one what we have is 5B. Technically the last one because after this we have theory ones. Let us do this. Alphabet and Company is a partnership firm with partners Mr. P, Mr. Q, and Mr. R. Okay, profit and loss is in the ratio 10:6:4. The balance sheet is also given. Mutually agreed that Q will retire. Who is going to retire? Q is going to retire. Q, oh, मुझे पता नहीं है. Q is going to retire. Sir, पूछो Q. No, no, don't ask me Q. No, it's Q is retiring. Sir, okay, I'll continue. Will retire from partnership, and in his place T is coming in. So Q is going, T is coming. Q is going, T is coming. Okay. From 1st of April 2019. For this purpose, following adjustments are to be made. Goodwill is to be valued at 1 lakh, but the same will not appear in the books of the reconstituted firm. So you have to raise and write off. They don't want to show the goodwill in the books of the firm. So we need to raise the goodwill and then write it off. Is there goodwill in the balance sheet? No. How do we raise it? We raise it by for PQR. PQR, and then we do writing of PRT. You get that? So here these partners capital accounts will be credited. Here these partners capital account will be debited, and in that particular ratio. Raising the journal entries goodwill account debit to partners capital account. Writing off the journal entries partners capital account debit to goodwill account. Done. So let us see this adjustment. 1 lakh, isn't it? I'll repeat whatever I just told with respect to goodwill. What is that you do? You will raise and write off. Raising goodwill account debit to partners capital account, writing off partners capital account debit to goodwill account. Have a look. Here they've done straight away adjustment. Okay, never mind. I can show it to you. What are the partners' name? P, Q, R, T. Raising goodwill. How much is goodwill? Goodwill is 1 lakh. Okay, what is their profit sharing ratio? Profit sharing ratio is 10:6:4. 10:6:4. Half 50,000. Okay, this is all credit. Okay, credit to the partners. Now I'm supposed to debit it. Same 1 lakh. Q will not be there. PRT. But what is the ratio? Have they given the profit sharing ratio? 2:2:1. PRT in the ratio 2:2:1. So 1 lakh 2:2:1 is 5. So basically 40,000, 40,000, 20,000. 40,000, 40,000, 20,000. Now have a look. P 50,000 credit, 10,000 debit. So basically I'll remain with 10,000 credit. Credit is only higher. Here it is 30,000 credit. R it is 20,000, but debit sign is more. See, debit. And here it is 20,000 debit. So ultimately, have a look. R and T should be debited. R and T should be debited. R and T should be debited. What, 20 and 20? What have they done? One second. Let's have a look. Goodwill is to be valued at 1 lakh, but same will not appear in books of accounts. Okay. Total capital is 2 lakh. New profit sharing ratio. Perfect. 2:2:1 is it? PRT. RT or P RT 2 is to 2 is to 1. 40, 20. This is correct. This is how it should be adjusted. Good. Don't worry. This is how it should be adjusted. I think there's some small error in the question, small error in the answer. You guys do it this way. Don't let that affect you. You guys do it this way. Perfect. So this with regard to the goodwill adjustment in this particular question. What do? We credit P and Q by 10,000 and 30,000. We debit R and T by 20,000. Okay, oh, correct. It's correct, isn't it? See, R 20,000, R 20,000 debit, T 20,000 debit, P 10,000 credit, Q 30,000 credit. Correct again. Sorry, I didn't see it correctly. I was in a little hurry. So R and T 20,000, 20,000, P and Q 10,000, 30,000. So goodwill adjustment done. Let us see the next thing. What have they given? Then normal reconstitution, building and plant and machinery 5%, 20%. Fine. I'll do it from the beginning. I think rest of the adjustments are easy. I'll show it. I'll run you through this. Huh? Don't worry. First one. What are the opening capitals? 80, 80, 20, 30. Partners capital account 80, 80, 20, 30. Done. Next, what is the next item in our balance sheet? We have reserves. Okay, this is done. Reverse is 20,000. 20,000 has to be shared between P, Q, and R in 10 is to 6 is to 4. Have a look here. Shared between P, Q, and R 10 is to 6 is to 4. 20,000. Done. Shared. Okay, boss. Next, we have long-term debt. 3 lakh. This will appear in our balance sheet. 3 lakh. Balance sheet below. Balance sheet 3 lakh. Long-term. Oh, they have not prepared balance sheet in this question. Not asked for balance sheet, not prepared. So it would have, if you would have prepared balance sheet, it would have appeared there. It would have appeared there. Perfect. Next, what else? Bank overdraft 44,000. This would also go to balance sheet. To this, you will add that bank overdraft that will arise in that particular partner's capital account. I think we prepared bank overdraft account. I'll show you the opening balance. Overdraft 44,000 opening balance. Then we're done with that. 1,70,000. This will go to balance sheet. Assets 10,000. 2 lakh. This will all go to balance sheet. Now, there are a couple of adjustments. What are they? Buildings, plant and machinery are to be depreciated by 5% and 20%. So you depreciate those items in the revaluation account, 5% and 20%. Provision for doubtful debts is to be created. Investments are to be revalued. When you do that, whatever comes is to be shared between the old partners in 60,800 ratio. The 10 is to 60 to 4 ratio. The 6,800 appears in your partner's capital account, debit side, 80, 80, 40. No, not this. 30,418, 240, and 12,160. Done. And in the balance sheet, you will adjust this 10,000, 26,000, 27,800 from respect to building, plant and machinery and debtors accounts balances. So as to investment. Investment you will add, and these two will subtract. Subtract, add. Where? In balance sheet. Done. Then yeah, what else do you have? Investments ka. Oh, investments, what is that? Investments adjustment. Okay, are to be taken over by the retiring partner. Retiring partner is taking it, so his capital will decrease. So investment is reducing. Investment account credit, partner's capital account debit. So the journal entry when one of the partner takes over that particular asset is partner account debit to investment account. So I've written 15,000. In the balance sheet, whatever that investments is there, I would subtract this 15,000 there. Got it? Then we'd have to transfer his loan also to his account, Q's loan account. Then that's it. Whatever we get in each of the partners' capital account is balance in figure. They would have to bring in so much money, or if there is excess, they'll take so much money. Balance carried. And so that these are supposed to, capitals are supposed to be in profit sharing ratio. 80, 20, 30 is there, no? This comes to 1,30,000. That is your opening balance. They have told that to maintain the closing balance at 1,40,000. Have they mentioned total capital to be 2 lakh? Sorry, total capital to be 2 lakh. That 2 lakh has to be shared in that ratio. And they're maintaining that ratio. 1,60,000 plus 42 lakh. Yeah. So the closing capital between P, R, and T continuing partners is to be in 2:1 ratio. That comes to 80,000. $80,000, 40,000 to P, R, and T. And this is our balancing figure. These are not balancing figures. These are working capital adjustments, sorry, capital adjustments. That is the capital that should be maintained. And the balance is our balancing figure. Done. That's it. Not prepared balance sheet in this question, but if you do prepare, it will still tally. You guys can try it. Done. Now let me take you to the last question. The theory one. So far we've finished 100 marks. Now we're doing the last 24 marks. You need to answer 4 out of 5 questions. So you have an internal choice. And yeah, let's see. So what are the basic considerations in determining whether an item is capital or revenue? I have told you this: nature of business, purpose, recurrence, materiality, revenue recognition capability, revenue generation capability, and all this. The next thing is with regard to what exactly is the provision and contingent liability. There are differences. Provision is created against a contingent liability when there is probable outflow and reliable estimate, whereas contingent liability is dependent on happening or non-happening of a future uncontrollable and uncertain activity. When there is an activity in the future which will result in outflow of funds, and that particular event is uncertain and uncontrollable, and it is not in your it is in future, so then it becomes contingent liability. You create provision for a contingent liability when it fulfills the conditions like reliably you can estimate it, and there is a probable outflow arising because of that item. And there are few definitions. It's a present obligation arising because of a past event and all those things. You guys can read these through. 4 beautiful points what you can write in the exam. Yeah, the same thing what I told. Isn't it like possible obligation that may or may not arise, contingent liability, okay, depends upon occurrence or non-occurrence of future event. You get that? And it does not meet the recognition criteria, so it will not be recorded. However, with respect to this one, what is it? Probable that there is a settlement and outflow of economic benefits. That's when we do it. And it is a present obligation arising from past events. I just told you now, leads to outflow of resources. So same old thing. You can just basically read this out, and then you can try and inculcate this answer in your examination, and that will be really beautiful. Next one, what exactly is the difference between accounting estimate and accounting policies? Accounting policies is rules, conventions, basis of policies, procedures. Accounting estimate is based on the past experience, you tell something. Now, if you ask me, sir, how much time will you take to revise one question paper? If I tell you 3 hours, how did I tell it? Because I'm keeping in mind how much time I took previously to solve such a question paper. So that's an accounting estimate. Or now, what is accounting policy? Now, when I'm revising the paper, I have multiple methods. One, I can show the PDF like this, and then I can say this comes here, this comes here, this comes like this comes like this. That's one method. Other method is I can just show you the question paper, open my writing board, and then write the entire answer, or open my Excel sheet and then type the entire answer. So that's another technique. So both are correct. Which one to do is my policy. That is policy. Now, for instance, valuation of inventory, whether to follow first in, first out, last in, first out. Valuation of goodwill, whether to do simple average method, weighted average method, annuity method. All these are what? Accounting policies. What is accounting estimate? Now, if you tell the useful life of an asset is 10 years, how do you tell that? Based on the past experience. That is an accounting estimate. Depreciation is an accounting estimate. Useful life is an accounting estimate. Scrap value expected from the asset at the end is also an accounting estimate. Done. Why do we categorize items as accounting estimates and accounting policies when they are so similar? Pretty simple. Change in the accounting policy. Change in the accounting policy, we should give retrospective effect. Change in the accounting estimate will only give prospective effect. I repeat, change in the accounting policy, we give retrospective effect. Change in the accounting estimate, we give only prospective effect. Meaning prospective meaning we'll change it from now. Retrospective would have to go back to the past and then change it from there as to how would it have been affected if it would have been changed from the beginning. Done. So you guys can read this through as to how to go about with this. Then we have objectives or advantages of accounting standards. If there are no accounting standards, there is no comparison, there is no reliability, there is no standardization, there is a lot of confusion, there is also difficulty in selecting accounting policies. I'll repeat, if there are no accounting standards, there is a lot of ambiguity, no comparison, no standardization, no uniformity, difficulty in selection of accounting policies, and there is no reliability. So the advantages of accounting standards is it brings in comparison, it increases reliability, it makes things more reliable, trustworthy, standardization, and it eases selection of accounting policy. It will tell us how to select an accounting policy. That's with respect to accounting standards and its benefits. You guys can read that through once. And then we have the last question. That is another choice question that we have. You could have answered 4 out of these 5. Let me do this one. Shall I? Okay. There is a charitable, they've given recipient payment account extract. They want us to do subscription account. We'll do that. So much money is received, 2,07,000. So I'll write in my subscription account 2,07,000 on the credit side. Why? It is basically received. Cash account debit to subscription account. In subscription account, I would have to write by cash account. I repeat, when that money is received, the journal entry is cash account debit to subscription account. So in the receipts and payment, they written to subscription. In subscription, I would have to write by cash. That is nothing but by receipt, 2,07,000. Perfect. Then what else do we have? Trust had how many members? 1,000 members, each paying 200. So 1,000 members into 200. So my annual income is 2 lakh rupees. 2 lakh rupees is my income, which should appear in income side, income and expenditure upon my income side. So I'm transferring so much to my income. Income should be credited. Debit should be given to subscription account. I repeat, income should be credited. Subscription account should be debited. So the journal entry will be subscription account debit to income and expenditure. Subscription account debit to income and expenditure. So in subscription account, you have to write on the debit side how much? 2 lakh. 2 lakh. How would I arrive at this? 1,000 multiplied by 200. Okay. Now, what else have they mentioned? Outstanding subscription as on 31st of March 2009. This is opening outstanding. During the beginning of the year, at the beginning of the year only, they were supposed to pay us 27,000. So what is this? This is asset debit side opening balance. So I would write here 27,000 debit side opening balance. Why? Last year's subscription, what they were supposed to pay in the last year, they have not paid. So it is my asset opening balance on the debit side. Next, show subscription account. That's it. Now 18,000, I think this should have been outstanding from the last year. So it's been paid. So this will come on my liability side. No. Yeah, perfect. Not an issue. So 99,000 is received in advance for the next year. So that they've written it over here. And outstanding subscription is the balance in figure. And that's it, guys. This outstanding subscription means there can be opening and closing. You can write that 18,000 separately and then write the balance, but never really mind. What about this 9,000? This 9,000 is a subscription received for next year. It is a next year subscription received now. So this is my liability. Liability closing balance comes on debit side. Closing balance comes on debit side. Opening balance on the credit, closing balance on the debit. So this is subscription in advance 9,000 and the balance is my outstanding subscription. So that's with regard to this question. A simple one, not very difficult, but I put it extra because I wanted to give a little more weightage to the NPO chapter. And I've taken few chapters lightly in this particular paper. Chapters like this, I've not put a question on company accounts, not like intentionally. Like I knew that people would be smart enough for journal entries, and the previous paper, however, had that one. And goods and return or approval was also there in the previous mock paper. So I took a little marks from that side and then put a little more weightage on your final accounts, making it a little bigger question, and also putting in little on subscription account as a separate question. So what we guys need to remember is there's no hardcore rule that definitely there'll be a question from a chapter in the exam. There can always be a question paper which doesn't have the questions from the chapter that you love the most. So you'd have to love the entire syllabus and then take it ahead, finish the course, and then love whatever and whoever you want to. So that's with regard to this session. I hope I've been able to add little value to your preparation for CA Foundation examination. So we'll be really happy to hear from you as to how did you people do in your examinations. And I'm really excited and hoping to see you all on the other side of the foundation, that is at CA Inter. And I'll be waiting. See you there. So till then, stay in the game. Bye-bye.